Good afternoon, everybody. It is 4 o'clock, and we are expecting a lot of people. We had a lot of interest for our two distinguished speakers. So we are going to start at 4:02. It's now 4:01. We're going to give this another 60 seconds. So grab a cup of coffee, answer one more email, and we will be back with you in 60 seconds at 4:02. Thank you. Okay, it is 4:02 and we are going to get started. So here we go. Oh my goodness, I have missed everyone and how Agency One has missed all of you. I am so pleased to welcome everyone to the first webinar in Agency One's 2021 webinar series. Happy New Year, and we hope that everyone is doing well and that you and your families are safe and healthy. 2020 was a very challenging year for Agency One and our advisors. We are thrilled that it is in the past and we are looking forward to 2021 and helping you and your clients. In that regard, a brief introduction to Agency One for the new advisors that have joined us today. We are a very high-touch exclusive brokerage general agency. We have a platform called the Agency One 100, and the advisors that are part of this group are like-minded, and for the most part, we consider them to be family. We focus on life insurance and fixed annuities, and if you have other needs, like disability insurance or life settlements or standalone long-term care, we have strategic relationships with advisors. I'm sorry, strategic relationship with the best providers in the industry to refer you to. Agency One truly has the best underwriting department in the industry, led by Dennis Bartos, and an advanced markets and case design department led by my partner Gonzalo Garcia. If you want high touch, personalized attention, advocacy, and want to feel like you and your cases are important, then Agency One is or should be your brokerage general agency. If you would like to learn more about us or have a case you would like to discuss, please reach out to me or Gonzalo or Dennis or Ed. In 2021, Agency One will be hosting bi-weekly webinars, and by that I mean every other week, generally, on either Wednesday or Thursday at 4 o'clock Eastern Time. We are also going to be hosting focused study group-like webinar tutorials for no more than 5 advisors on specific topics, and you will be invited to join us for those webinars as well. We also hope to be hosting an in-person annual meeting in October. We are also continuing our weekly One Ideas, and for those of you that are currently working with us, you will be receiving your 2020 year-end scorecard by the end of the month, fingers crossed. I have some important announcements about what Agency One has planned for the next few weeks, and I will be sharing them with you at the end of this webinar. Now, I would like to introduce our first webinar for 2021. As we all know, we have a new president, and the Democrats are now controlling the House and the Senate. What does that mean from an estate and tax planning perspective for you and your clients? What changes can we expect now and in the future? What should you be doing, talking about, and presenting to your clients that are concerned about retirement and their businesses? I am thrilled to introduce our two speakers that will be addressing all of these topics and more, and they will also be available to answer any questions you might have. First, allow me to introduce our longtime friend and colleague, Alan Brown. Alan is a tax and trust lawyer with 40 years of experience working for family-owned companies and high net worth individuals throughout the country. He creates individually tailored structures for clients that allow them to maintain control of their businesses through multiple generations while also limiting personal estate and gift tax obligations to the minimum amount allowable under the law. Alan believes that life insurance is a very important tool for accomplishing those objectives. Joining Alan is a longtime friend and colleague of Agency One, Randy Zipse. Randy is the founder of Zipse Wealth Consulting LLC, which provides advanced market support to top marketing organizations and producers like Agency One. Randy has worked in the life insurance industry for over 25 years and has managed the advanced markets and marketing departments for several major carriers and marketing organizations. He is a frequent industry speaker and has written numerous articles on estate, business, and charitable planning. He is also the author of the National Underwriters Field Guide publication. Randy practiced as a CPA before attending Drake University College of Law, where he graduated first in his class. Randy, if I graduated first in my class, I would still be touting that as well, but I didn't. Anyhow.
You got to get something out of it,
and
Kathy.
Also, that's impressive. And also joining Randy and Alan is my partner, Gonzalo Garcia, who not only will be listening intently, but will also be periodically asking questions and also fielding any questions that you all may want to ask our presenters. So without further ado, please allow me to turn this over to Alan and Randy. Thank you.
Thank you, Kathy.
Thank you very much, Kathy.
Well, Alan, let's just, we only have 45 minutes to get through this. Why don't we, let's just start this off with kind of what the obvious is. First of all, here are kind of the things we're going to talk about, right? We're going to go through some of these things as we go through. Alan and I are going to talk about, first of all, what we see, where we see the tax changes going in 2021. And then we're going to talk about some specific planning ideas based on where we believe the tax law will be, but certainly but keeping things flexible enough in case things don't go the way everybody expects them to go. So, there is kind of what our agenda will be. Alan, if we just flip to the next screen, I'll get you started right on really. What do you think? What do you see? Obviously with the Georgia elections that came down, we're in a situation now where the Democrats have, although very, very narrowly, but they have control of, of both houses and the presidency. What do you see happening from a 2021 tax law standpoint?
Well, obviously, we're one day into the Biden administration. We don't have a tax bill now, but throughout the campaign, now President Biden promised that we would have significant tax changes, particularly rolling back a number of the changes made by the Republican administration. We all remember in 2017, it took the Republicans until December to get their tax bill organized and passed and signed, and that was using the reconciliation process, which is the one that you only need a simple majority in the House and the simple majority in the Senate. So the first point is it looks like the Democrats are set up to do the same thing. I think my second point would be it takes a really long time to make a really good tax bill. So I think it's going to be months until we actually see what the proposals are. And we're going to go over some of those expected proposals here in a minute. And obviously, the biggest question, which you and I talked about, goes back to our constitutional law class in law school, which was a long time for me. Can an increase in estate tax and income tax be retroactive to January 1st? Randy, what's your thought on that?
Well, Alan, the answer to that is if we have any other lawyers on the call, is a good solid maybe. There isn't much authority out there, and the authority that is out there is a little bit across the board, but I think The real answer to that, Alan, is it's so unlikely that the Democrats would attempt to make a retroactive tax bill because the law around it isn't clear. But what is clear is that it's never very well received, especially when you're dealing with a tax increase as opposed to a tax cut, right? So I don't see them coming out with a tax bill and making it retroactive. It opens themselves up to some court attacks, whether it violates the due process clause or the equal protection clause. I don't know. I can make an argument either way, but just from a practical standpoint, I don't foresee it being something that they do. How about you?
I completely agree. If you have the votes to get it done, why not do it in a way that it's absolutely certain? And if it's retroactive, it will be subject to multiple court challenges, and then we all have to wait for those to work their way through the courts. Now, do you agree that it could be effective as early as the date the president signs it? So if they get everything organized and President Biden is ready to sign it August 1st, don't you agree that at least on the estate and gift tax side, that could be effective August 1st?
I think there's a very good chance it'll be effective when signed. And I would just tweak what you said a little bit about the timing of it. I think there's a bit of a distinction between where we're at in 2021 as where we're at in 2017 with the Republican tax bill. Keep in mind, then President Trump had not really put together a specific list of tax items that he wanted to implement. You know, he had some broad statements that he made about tax cuts and some things, but there was not really a detailed tax, blueprint that was there. President Biden has got some very specific items that he's talked about and campaigned on. And the other advantage, if you want to call it an advantage, that Biden has here is that it is a tax increase. So when you're talking about the procedural mechanisms from a Senate standpoint, it is immensely easier to pass a tax increase bill than it is to pass a tax cut bill. And so I think we're in a little bit of a different situation that might lead us to a faster tax bill this time around than we did 4 years ago, Alan.
Okay. I'm telling my clients that I think the first 3 months are safe, the first quarter, and after that, I just don't know. What do you think? Does the first quarter sound like it could be safe? I'd just be so surprised that they could get a tax bill passed and signed in less than, what do we have, about 75 days?
I haven't seen it within the list of things that are first 100-day items. So okay. I think you're probably right, but again, it would be easy to pass from a reconciliation standpoint. It is easy to pass a tax increase bill. So it's possible that when they're trying to do some items that require spending, they might merge the two together. So, it's not impossible, Alan. It could come faster as a way to fund some other items that would be harder to do from a reconciliation standpoint.
I agree. I'm going to work with my first quarter. So looking at the next slide, let's start with gift tax and estate tax, and then we're going to do some work on income tax. So right now we have these enormous exemptions from gift and estate tax, 11,700,000 per person, 23,400,000 per person. And so just so we have common language, I'm going to use the word grantor gift trust. There's at least 20 different labels for that, but let's go with a grantor gift trust. So the person who founded it, it's irrevocable as to him or her. The trustee and the beneficiary have a lot of flexibility. It is a completed gift for gift tax purposes. It is disregarded for income tax purposes, that wonderful rule that allows you to swap assets in and out and sell appreciated assets without recognizing any income tax. And it's the best asset protection under American law. So
Alan,
if someone...
I would just add for our listeners, especially in the insurance side of things, this is just what so many people will refer to as either an IDIT or an intentionally defective insurance trust. Like Alan, I can't imagine a worse term from a client communication or marketing standpoint than intentionally defective, irrevocable insurance trust. I mean, if you went out of your way to come up with a bad name for something, Alan, that would be it. So I prefer grantor gift trust, but I want people to understand that's what we're talking about. This isn't a new concept. You guys use this all the time.
Right. So islets and idiots and dynasty trust and all of those words all mean the same thing. We'll use grantor gift trust. So if someone has one or can quickly assemble one, Randy, what are their options this quarter?
Well, as the slide talks about here, the exemption right now is $23 million for a husband and wife. One thing I know for sure, Alan, it's going back down to half of that at some point in time. It's scheduled to go back down there at 2026. So, you know, the clock is already starting to tick on that time. But under the Biden tax proposal, that clock is going to expire a lot faster than 2026. So for clients who can afford to, and who, as Alan's next bullet point up there says, are comfortable making gifts, you should be making gifts of highly appreciated assets and using that exemption right now that's available. Because if you don't use it and that clock ticks back to half of what it is right now, that is money that the family has lost. You will never get that back. I don't see that changing anytime soon. I surely wouldn't want to count on it going back up to these levels again during my lifetime. And I'm only 58 years old. So if you're talking to clients who are 70, 80, I don't see us being in a better position from a gift making standpoint than we are right now, Alan.
Yeah, we're never going to see these numbers again. I'm confident of that. And just to say it, if you have someone who is so wealthy that they can do the 23 million and they say, what else can you do? As you said, working with appreciated assets, they can make tax-free sales. And the promissory note for that sale only has to use the applicable federal rate. And right now, the applicable federal rate for a 20-year note is just 1% and change. So that's also the lowest AFRs we've ever seen. So the combination of the highest exemptions and the lowest AFRs for sales, I mean, most clients can move everything that they need to move using just those tools, gifts and sales.
Yeah, I mean, Alan, those are the things that we've been talking about, obviously, for a couple years now, right? I mean, a sale, if you will, sale to the intentionally defective trust, right? When I can take and I can transfer my assets, I can replace it with a note. First, and next of all, I have a 30-year note in my estate. You're an estate planning lawyer. You filed a few estate tax returns in your life, Alan, even more than me. If I die holding a note that lasts for 30 years, payable, from my trust to my estate, and it's paying 1% interest, and I happen to die 5 years from now, what kind of discount am I going to get on that note in my estate? So not only are you taking advantage, just that discount alone makes this transaction a slam dunk, even ignoring the growth on the asset that you're transferring.
Okay, so this is great for clients who maybe have been thinking about this planning, they were getting ready to do it, they just didn't get it finished in 2020. We're giving them the first quarter of 2021 to finish that. But you and I had a fun discussion about, and I call it tax planning for the indecisive, someone who has enough wealth that if the exemptions get knocked back to 2009, that was $2 million of gift exemption for a couple and $7 million of estate tax exemption for a couple. So they've got enough money that they're worried about that, but they just can't quite pull the trigger. What have you got for them, Randy?
Yeah, Alan, I don't think this is going to come as a shock to a lot of people on the call who've worked with successful, affluent individuals. A lot of people who are successful and become affluent are just a little bit of a control freak, Alan. I've ran into a few of those over my life. And they don't really want to part with assets while they're alive because they believe they can manage the funds for themselves and for their family better than their kids or their grandkids or anybody else can. And you know what? Maybe they're right. And then you also run into those people that they might be worth 50 or 100 million dollars and they're convinced that something's going to happen and they're going to need to get the money back again. Okay, there's really no particularly good reason to argue with those kinds of folks in my mind, Alan. To me, what you're talking about here on this slide is the way to get this done. what you don't want to have people doing is not doing anything
Right.
and waiting to see what that tax bill is going to do. Because if I don't know if it's going to be April 1st, Alan, or it's going to be August 1st, like you said, or it's going to be December 1st when that tax bill hits. But when that tax bill hits, are you going to have a few people calling you up and wanting to get some estate planning work done?
You know, I'm willing to work through the night, but it's really hard to move a bunch of $1 million in 24 hours.
So, you know, what makes a lot more sense for those, if you will, indecisive people is for them to call their tax advisors now. Get in the queue now. Put that planning process in place. Create those grantor trusts, and then transfer assets and take back a note. If I create an irrevocable trust, Alan, and I sell an asset into that, maybe that's an FLP interest, or maybe it's an LLC, or maybe it's a fractional interest in a piece of real property, or maybe it's just a note. I don't know what I'm transferring, but whatever I transfer, and I take back a note, I have kept a string that I haven't irrevocably done really anything, but have put myself into a position that if I make a phone call to you, Alan, you can, and you are able to help me virtually overnight.
Right.
Right? I mean, you want to elaborate?
Right. That you can do. If you've either got the trust or you put the trust together, you sell those assets. In my example, it was 5 million. Well, your personal balance sheet went down by 5 million of assets, but back up 5 million by the note. So you haven't made your gift yet. Meanwhile, the trust has the assets, but it also has that liability. So at this point, if there is no tax bill, or if you just decide this is planning that makes you uncomfortable, you call up your trustee and say, I'm calling my note. You need to give me back my $5 million worth of assets. There's no gift tax consequences. There's no income tax consequences. I'm exactly where I was. But the flip side is, let's say it is April 1st. You see the first, words of the tax bill, and Biden is doing exactly what he said he was going to do. He's going to roll back those exemptions, and you say, okay, I guess I really need to do this. Alan, what do I do? All you do is take that note and say, here, trustee, I am now making an irrevocable gift of this note to you that completes the transfer. Now the trust owns the $5 million free and clear. Go out and file your gift tax return. You've now done the planning that everybody else wanted you to do. And your kids will celebrate you and your grandkids will celebrate you.
Right. So, obviously there's a transaction cost to get you to that point where you're virtually on the brink, but you want to be on that edge, because if you're not on that edge, you're not going to be in the front of the line when
Right.
every good estate planning lawyer in America has more clients suddenly than they have time. And that's what's likely to happen here when that tax bill gets introduced. And it says that it's dropping the exemption in half. That is that is going to cause a very, very, very busy bunch of estate planning lawyers for
Right.
a while. And you don't want to be trying to get into that queue.
Clients will get motivated. Let's flip over to the income tax side. What do you see happening for individuals on the income tax side?
Well, as the slide says there, I think Biden has been very clear all along that they're going to reduce the top income tax rate back down to what it was before the Trump tax bill. So we're going to go from 39.6 back to 30.
So back up to 39.6.
Sorry, yeah, it's going to go back to 39.6 again, where it was at before. I don't see it getting higher than that, but I think that's almost a sure bet. I think if there's anything in there, that's a sure bet.
That's very easy. That's just turning back the clock.
Yeah, so I think this is about as close to a sure thing as you're going to find, right? And the other thing that I think President Biden has been very specific about is the capital gains for the very wealthy, as defined here as $1 million of taxable income. I think he's been pretty consistent with saying that those should be taxed at ordinary income tax rates. I think they're going to.
That isn't a large number of people, but that is a huge change for that group.
Exactly, because there's a big difference between 39.6 and 15 or 20%, which is what they've done historically. So you're basically doubling it.
And then the one that terrifies me, and that is not based on wealth, it actually would hit every single taxpayer in America. Tell me what you think they're going to do with basis at death. I've seen some conflicting proposals. I couldn't find in print a definitive proposal, but I didn't like a single one I saw. What did you
Well,
see?
everything that I have seen, I haven't seen anything really conflicting even, Alan. I've seen consistently what the Biden tax proposal has been outlined as doing is cutting the exemption back down to what it was prior to the Trump cut, which we've already talked about. But on top of that, not instead of that, on
Right.
top of that, they're talking about doing away with basis step up, which,
So,
as you've said, if that's true, that is, first of all, even just a doing away with the step up, even if you didn't change the estate tax rule, is a huge, huge
that's
thing. But the
earthquakes. That's
combination of
earthquakes.
those two is gigantic from a
Right.
planning perspective.
So I guess the conflict was just get rid of the step up and we're done. So it's now carryover basis from one generation to another, or is it the next level that I saw at least some comments about, that you would actually mark to market? You would actually pretend that the decedent sold all of his or her appreciated assets at death, so you'd actually get hit with a capital gains tax in addition to the estate tax. So what do you think? Tax at death or carryover basis? Which do you think is the winner?
I've seen most of the proposals I've seen have been talking about the carryover basis, but we know what happened the last time that was tried. It was a disaster from a record keeping standpoint. But I think, Alan, that the time has maybe changed enough with technology these days and everything being digital, and the world is a little different than last time we tried it. Maybe the world is ready for that, but you know what? My parents are still alive and they're in their 80s, and I'm pretty damn sure my dad couldn't tell me what the cost basis is on half the stuff he owns. So I don't know if the world is far along as people think, but that I don't know.
That would be an earthquake change. But let's now focus it. Every one of these is bad in terms of, should I hold my appreciated assets for a future sale? What we know with certainty is if you sell an asset now, your maximum capital gain is the capital gains rate. It's not the ordinary income rate. And if you were holding an asset, hoping to die with it and getting a step up, that may be gone. So
that is, I think, on everything we're going to talk about here, Alan, I think you've hit on the most difficult part of this planning process there is, because if these laws change the way they're projected to change, it's turning on its head the kind of estate planning that we've always told our people we work with to do, right? It's hold your assets, your appreciated assets, and get the basis step up when you die, right? Now, if you believe this is going to happen, and I do, I think we're either going to see a carryover basis or a taxation of the capital gain at death. I think one of the two is going to come. Maybe there will be some kind of exemption for smaller estates or something. Maybe that it's not being talked about, but maybe somebody will slip something like that in. But if you're very wealthy and you have appreciated assets, you very well may be better off liquidating those and paying the relatively low capital gains tax we have right now and investing that in something else. I would suggest life insurance for a lot of reasons we'll talk about in a little while, but I don't think I would hold that card if it was me. If I were advising, if my parents were worth millions of dollars, when they're 80 years old, I don't know that I would continue to tell them to hold their assets and wait for death. I think now is the time to sell it. I really do, Alan. How about you?
Prices are high, market is high. Interestingly, real estate outside the big cities is skyrocketing as people don't want to live in big cities as much. So there's an enormous amount of assets that could be sold this quarter at what are probably the best prices in a decade. We also have the lowest taxes in a decade. So I think at least the consideration for a person in that situation to sell now is really powerful. It's not for me to tell. I would hate to have someone sell something and then have them yell at me that it was the wrong time to sell. So I don't give investment advice. But let's now put that cash on the table. The individual made the decision, made the sale, paid the minimals tax, has the cash. How can there be a better place to invest for your own retirement than in life insurance? It's unrestricted how much you can put in compared to an employee benefit plan. Tax-free loans, tax-free return of your basis, tax-free growth, tax-free death benefits. Wouldn't that be the place to put a significant amount of those sale proceeds?
Well, Alan, I guess if I hadn't believed that for a long time, I wouldn't have been in this job for 25 years. But I believe it more this afternoon than I've ever believed it. I mean, if I'm sitting here right now, I can't imagine a place I would rather have my cash sitting than a life insurance contract, because as I look at any other investment that I might have, I don't see how these tax law changes are going to improve that. And if you've said, maybe the stock market will keep going up, maybe real estate prices will just keep going up, inevitably. I don't know, but geez, I would now doesn't sound like a bad time to cash out of some of those things and put it into something a little more conservative, if you will. I don't know whether that's a fixed life product or whether it's an index product or whether you want to just keep it in, with a variable contract with, the life insurance wrap around it. That kind of depends on a client's risk level. But man, I sure like, at least as part of your portfolio, I sure like, getting out of some of that high risk, and high appreciated asset and putting it in life insurance.
It's a great opportunity to diversify. And correct me, because I'm not the expert, but I tell my clients, whatever you are invested in now in taxable, you can find a life insurance policy in a life insurance company that will let you invest in essentially the same investments. I think of life insurance being able to invest in just about everything.
I mean, I've been doing this job now, it's my 26th year in advanced sales, and 26 years ago, variable life contracts were very limited on what kind of funds that they had in them. It's as you've said, it's quite there's a lot of options. If you have access to multiple insurers, you can find a lot of different funds there. And, or like I said, or just invest in an index, as a way to offset. Right. You can buy into an IUL product that's got a floor. You can get a 1 or 2% floor. You give up something on the top end from a cap, but you got a 2% floor, and you can still, sometimes the caps on those things are 10, 12, right? And then you get the tax advantage.
I'd love to get 10 or 12 on my investment. That's why I'm still working.
Well,
so
I'm not.
Randy, let's switch over to the business side. What are you looking at for some pretty unhappy changes in the business side?
Well, I think that what, as we all know, the Trump tax bill was really, first and foremost, it was a business tax cut, right? I mean, the individual changes we talked about, the estate tax was a big one, if you will, but the drop in the marginal income tax rate from 39.6 to 37.
Right. It didn't go down 10%, right?
Right.
So,
but the corporate tax rate from a C corporation went down from 35 to 21.
That's a 25% cut. That's a big cut.
And I'm a little surprised that the Biden proposals are only increasing it up 7% from 21 to 28. I would, if I were a business owner, I'd consider that to be a win, frankly. I think that's going to happen, and I would have guessed it was going to be more, but that's what they're looking at.
And we don't see the text yet. It could be worse. It could be worse than 28.
But that's what they're talking about. And the other thing, again, doesn't surprise me in the least either, is 199A. If you owned a pass-through entity, whether it's an LLC or a FLP or an S corp or whatever kind of flow-through tax entity you had, you got a 20% tax cut. Basically, if you haven't already figured out 199 works, it just says, what if you made $1 million? We're going to pretend you made $800,000, right? We're just going to throw 20% off the tax and tax the rest of it. That's a heck of a deal. And
that's a great deal.
And they're not throwing even all of that out. I mean, the Biden tax proposal, I would say, is pretty liberal there. They're going to phase it out at $400,000 of income. So a lot of small business owners are still going to get the advantage of 199A. It's really not that bad, but for people making $1 million, getting it dropped down from getting 200,000 whacked off the top is a lot better than 80,000, right? But
right. So the positive is it looks like that benefit, which was supposed to make C corporations and pass-throughs taxed in a similar way, looks like the benefit is going to stay, but it's certainly not going to be, I don't see the personal tax returns of my clients, but I also see the business. If you're running 4 different businesses, it's not very hard to get to 400,000, and then anything over that, you've completely lost that benefit.
Yeah, I mean, that's a big change for business owners, and and for large C corporations. I don't know how many people here are working with giant corporations, but they're also talking about reinstating the alternate minimum tax at some level. Although from what I've read so far, that is a very high level. So we're probably talking about some major corporations, probably not the ones that you work with. But the idea of an alt minimum tax, they're talking about having back again, and they're also talking about an excise tax for people who offshore certain aspects of their business for sale back in the United States. So people that are taking service centers overseas or are manufacturing certain parts of their their products overseas and bringing them back, they're talking about excise taxes on those kinds of folks as well. So there's going to be a lot of changes in the corporate tax law, but so for business owners, I think it's important to keep an eye on that. But I do think, Alan, that even for even if the C corp rate goes to 28, things like corporate split dollar for the owners of C corporations are still going to be a very powerful tool. I mean, 28% is still a heck of a lot less than 39.6.
Right, and by using the cash out of the company to promote the premiums through split dollar, you absolutely have used the lower the lower bracket, the lower tax rate. So I see that's very, very popular right now.
Yeah, I mean, that's one of the things that I've been talking about, with all the people I work with who own C corps, right? I mean, that's the planning that we do, whether it's funding the buy-sell arrangements through corporate split dollar, or whether it's funding a supplemental retirement through a loan regime split dollar. But with all of our C corp owners, we're talking about split dollar designs. I don't see that as a change. So, if you're talking about what these business owners should be doing now, if you're a C corp owner, I think you should be doing split dollar now, and I still think that's going to be the case. I wouldn't feel bad about putting somebody into a split dollar arrangement now, because even if the law should change, I still think it's where they should be.
Right, because we've still got the spread. We've still got the spread. Right now, 21 is less than 37, 28 continues to be less than 39.6. So it's a great planning now, and it continues to be a great plan. But if overall income taxes on the individual side and the corporate, both corporate and pass-through business side are going up, to the extent there are investment assets inside the business, aren't we exactly where we were talking about an individual in retirement?
Well, Alan, I've ran COLI departments for much of my life.
Okay, tell me about what the COLI department should be investing in, and throw in 7702, something I read about but I don't really understand.
Well, I've always been a big believer in corporate-owned life insurance, and I think that's especially true since the Trump tax cut, right? Because if you own a C corporation, Alan, before the Trump tax cuts, and you were talking to clients that were C corp owners, what were they doing? What were their advisors suggesting to them? They were saying, why don't you just take out all of the earnings and compensation, pay the tax on that now, get the deduction at the corporate level, and be done with retained earnings in the C corp. We don't want to retain any earnings, because the C corp rate was 35, the individual rate was 39.6. Was it really worth retaining income for 4% tax arbitrage? Probably not, right? But when you're dealing with right now between 37 and 21, or going down the road, later this year when we're dealing with 39.6 and a 28, that's tremendous arbitrage. So people are motivated, should be motivated to leave monies in their corporations, right?
Right. And so once it's there, how are we going to invest it?
How are you going to invest it?
We're going to buy life insurance.
I know an asset that grows tax-free, and you can access the liquidity through loans without paying any current taxes on it, Alan. How would you like something like that?
Well, my quick story is I've always liked life insurance and life insurance agents. Some lawyers don't. I was a young lawyer in a big meeting and I said, I have just heard about a new investment tool. And I described life insurance without using the name. And I said, how many people like that? 100% said that's great. I said, how
Yeah.
many people like life insurance? It may be 10% said. I said, I just described life insurance. So you need to understand this product better because it's a very powerful tool.
It is, and for your C Corp owners, it's the same reason you should be buying life insurance if you're an affluent individual.
Right. So,
The tax aspects of the product, even ignoring the risk aspects, of it,
right.
there's
So,
key person insurance is important to begin with, even if the tax wasn't as efficient as it was. The product itself makes tremendous sense, but when you factor in the taxation of it, it's just as a slam dunk.
So
I think.
all the powerful arguments that say life insurance is where you need your retirement dollars, those same arguments are powerful inside a business. That's where you need your business investments. Would you agree?
I couldn't agree more. I think corporate-owned life insurance, especially for C Corps, is you should be looking at it right now, and nothing is going to change this year that is going to make that any less true.
So the last thing I wanted to hit, simply because I don't think it got as much attention as it should. We're all merrily, the estate planners were merrily running around doing IRA beneficiary designations to revocable trusts. And in the revocable trust, we have these very complicated rules intended to have an inherited IRA go to the lifetime, for the lifetime of a child or a grandchild, what got called the stretch IRA. And that just took a bullet to the head January 1st, 2020. And I don't think people are nearly focusing on what a big change that was, sadly, a parent dies and someone is, inheriting an IRA at 25. The difference between a 10-year payout and a lifetime payout is absolutely huge. And we're looking at paying it out over income tax rates that we think are almost certainly going up. So you gave me a great idea. Tell me what you could do with that IRA now that it has a dramatically reduced value instead of just doing a 10-year payout to a child or a grandchild.
I mean, Alan, I think this got missed because essentially it was a tax increase, right? And so
Right.
the Republican Congress and President Trump wasn't going to scream at the top of their lungs that they just did a tax increase. That's a little bit contrary to kind of where Trump wanted to campaign with this year, right? So
Right.
this really slid under kind of under the radar. Some of the nice parts of this were talked about from the Secure Act, how it makes some plans more available across different people who couldn't get in the past. And there were some very positive parts about this, but don't kid yourself, it was a tax increase. And as Alan has already said, planners would always say, when you pass away, extend that IRA, stretch it for the life of your kids, and you don't have to pay any taxation on those gains for, if you die when you're 70 years old and your kid is 35, and that kid lives to be 80, you've got 50 more years, to not pay any income taxes on those gains, right? It's great. My experience, Alan, always was the kids always took the lump sum anyway, and that planning never happened, even though that was the plan.
Well, you and I aren't responsible for the back end. We just have to build the front end.
Exactly. So I'm just saying, even though that was what got talked about, and mathematically that was absolutely true, that's what you should do. My experience is it didn't happen all that often. But now, if you look at that math and you say, okay, Randy dies at 70 years old. His adult kids are 40 years old. Those adult kids can't stretch that over their life expectancy anymore. You're not looking at a 40 or 50 year stretch. As Alan has said, it's limited to 10 years. If you do the math on that, Randy's better off taking distributions now, paying tax now, especially with these low rates that are probably going to go up, paying tax now and putting into a life insurance arrangement, probably in an irrevocable trust outside of the estate tax for my kids or my grandkids. The math is, you can run as many these as you want to, and I created a great tool to show this, but I can tell you that you almost never find an example where you're limited to 10 years, where you're better off with that 10-year stretch than you are taking the money, pay the tax, and buy the life insurance.
And did you look at insuring different generations? So for example, did you always insure the employee who set up the IRA, or did you also consider either insuring the child or the grandchild?
We did across the board, Alan. It really depended on depends on what the family's situation is, right? If you're in a situation where you're basically trying to replace that IRA because the kids need the money, right? Well, then you're obviously looking to insure mom and dad, right? But it's not unusual to be working with a client who has adult kids that have every bit as much money as mom and dad, oftentimes more, right? So in those situations, you're looking to, push that money down beyond children, down to grandkids or further down. So you just got to look at the facts.
When you brought it up, I was just on my own working on an example where we really put a lot of money into a policy on the child's life, and then the child took tax-free loans instead of actually getting the death benefit, and that worked really powerful.
Yeah, that's something I've seen done too, not just buying the death benefit, but actually just putting the dollars into life insurance from a cash standpoint. Yep.
And just in a minute, do I understand that with the change to Section 7702 rules, that sometime later this year, clients will be able to put more money into permanent life insurance than they have in the past? Is that a significant change?
We'll tease what I think is the next agency one WebEx they're going to do is going to be on 7702. And 7702 is, Alan, it really looks like it's going to dramatically change life insurance as we know life insurance right now. What we can be pretty sure of, it's going to increase the amount of cash values that are going to be able to put into permanent life insurance contracts before those policies are being taxed as a MEC. And hopefully everybody on the call understands what a MEC is and what a non-MEC is, because we don't have time to really go into that. But what it means is those new 7702 guidelines, when carriers finally adjust to it, which might be months, that could take longer than the tax bill, to be honest, when carriers, it might be 2022 when carriers start to really come out with what their new products will look like.
So that's part of our long-term planning. If we're talking to clients and we're saying, you really need to jump on this quarter, we can't be sitting around waiting for redesigned policies. I think we need to use the policies we have right now, don't you?
I think you would be poorly served by waiting for that, because the tax bill could come in before those new products do. You know what, Alan? And if you buy a product now and new products become available that are better than the ones you have now, there's always 1035, right? And a lot of carriers offer internal exchanges as well. But I wouldn't wait around for, those. I don't know when the tax bill is going to happen, and I don't know when carriers are going to come out with their new 7702 compliant products, but I wouldn't wait. I guess that's me. I wouldn't wait. Yeah.
Gonzalo, you have popped up. We were ready to take questions if you have additional questions for us.
Are you guys done? I don't want to cut you short. I just figured I'd come right back in and.
We are ready.
Yeah, we have a whole host of questions. Before I get there, I want to ask you gentlemen to comment on a couple of things around the Tax Act, or the proposed or the Biden Tax Act, as I'm sure we'll know it. Is there any conversation around, there was a comment from somebody that said something about adding I presume the Social Security tax, OASDI, add back the 12.4% for earned income over $400,000, which is currently capped at, I guess, at 142.8, right?
That's the proposal. There's going to be they're going to stop it at the current levels as adjusted for inflation. So I don't know if that's 137 or 142 or whatever that is. But it's going to stop at that level, and you won't pay it again until you get to the 400, and then it picks back up again. So that's going to be an additional substantial tax on high income earners, and that's probably will pass. I suspect that to pass.
So in effect, that would be added on top of the 39.6%. So you conceivably you're in almost a 60%, almost a 50% tax rate over 400,000.
Yeah, I mean, it's just like the tax now on the first 137 you earn, it's going to be stacked on the back end. So if you want to count that as an additional marginal tax, which I think it's fair to say, that makes the tax rate close to 50%. I mean, roughly on the top end.
Yeah. So just kind of one more reason to really be thinking about income tax planning versus just estate. You know, everybody thinks the Biden tax cut's going to be all about estate tax. I mean, we're going to have a massive income tax issue here.
It's not going to do much to people earning less than 400,000. He's been very consistent with that. All the proposals I've seen are consistent with that. But if you're earning $1 million or more a year, you're going to pay a lot more in taxes.
Yep. Got it. And I know a lot of people on this call, and I know they have a lot of clients that are earning well into the 6 figures and then certainly into the 7 figures. So something to think about. A few questions from the audience. Can you discuss the tax rates on completed gift trust and the benefit of ensuring future beneficiaries for tax efficiency? So I think that the question is ensuring, so completed gift trust and then ensuring younger generations with those dollars.
I'm a huge proponent of what I call the diversified portfolio of life insurance. When I see a well-funded trust, I ask the question, why aren't we insuring everyone in the family and putting that in the trust as part of a portfolio of life insurance? Sadly, if you get 20 people, somebody's going to die young. All the policies are going to perform, and that one's going to perform in ways you can't even imagine. The numbers will be great. So yes, I think the beneficiaries all should be possible insureds. Randy, do you agree?
No, I think that's right. I mean, I think you got to look at the situation with the family where you're at, right? But I think that people too often stop looking who I should insure at the oldest matriarch of the family, and they don't go down and they don't look at the rest of the family and understand that you're planning for a long term and not just a short term horizon. I agree with that.
Yep. Well, and I'll put in a little plug for Alan here. We've done a number of proposals and plans where people are insuring multiple generations, and if you want to know more about that, Alan is the guy to talk to, because he's written a lot on it, and we've worked with him on developing some analytics and some spreadsheets on that. So next question is, can the presenters comment on the likely challenges that the insurance carriers will continue to face in such low interest rates, especially in light of their current comments? Randy, that's probably more suited for you, having been in an insurance company for a while. I certainly commented on that last week in my one idea. So why don't you give us a little thoughts on that?
Well, Gonzalo, I'll be interested to hear what your thoughts are, but I think the person that asked the question already knows what the answer is. Life insurance, there's a mortality aspect of it, but permanent life insurance, cash value life insurance is an investment play. And if insurance companies are investing in largely low risk investments, which they're required to from a regulatory standpoint, they're not earning high rates of return. So there's going to be a continued pressure on insurers on how they can price life insurance, right? But we're in a competitive world, so it's carriers would love to adjust their pricing and their products a lot more than they have so far, but there's a lot of competition out there, right? So I mean, that's not going to change. Prices are going to continue to go up, and performance of products will continue to go down to some extent, but it's unless companies just want to get the heck out, and I probably wouldn't be here right now if there weren't some that think that way. As long as companies want to play in the space, they've got to compete and hope in the long term that those things change, right? That's kind of where we're at.
Yeah. Well, I mean, I'll just comment quickly on this because I just did quite a bit of research on it to write that paper from last week. But if you think about insurance companies, to Randy's point, investing in fundamentally the benchmark is 10-year treasuries for the insurance company. So we're right around 1.1% as of last week. Dividends are going to be affected. They continue to come down. Caps on IUL. I mean, the caps are based on the spreads that they have for the options margin, and as their portfolio yields continue to come down, you're going to have more compression on their options budget, which means you're going to buy lower caps. And we have seen caps come down, certainly over the last year, certainly since COVID came out. So we've seen a couple of cap moves down from a number of carriers. we're going to continue to see pressure on long-term guarantees. So you've seen a number of companies get out of guaranteed universal life. Reserving for those guarantees is very expensive. I think we're going to see more product along the lines of, the protection UL at John Hancock as an example, and not to call anybody out specifically, but it's a current assumption product with some life expectancy guarantees. And I think the move is going to go down that path to take a little bit of pressure off of these reserve guarantees that they have to set up. So, IUL is going to be impacted, dividends and whole life are going to be impacted, and guaranteed universal life is pretty much already impacted. I'd be very surprised if we had long duration guarantees in single life or second to die guaranteed universal life by the end of the year, if interest rates stay.
And I guess, Gonzalo, I agree with everything you've said. And the other thing I would add is I think you're going to see more and more people funding high cash value life insurance, because it takes a lot of that risk out of that, from a risk standpoint. And when the 7702 regulations are implemented, allowing you to put more cash in those policies, the more cash you can push into a life insurance contract, the less net amount of risk you have and the less volatility from a carrier standpoint that you have. And they'll probably be able to, take a little bit more, if you're pushing more cash in, part of that will probably be they'll reduce the returns, maybe that you'll see on that stuff. But I think you're going to see more and more high cash value life insurance and less really death benefit oriented products, because those get harder and harder to price.
Yep. And 7702 will help, and I think we'll probably see a lot more on the variable space, assuming the stock market doesn't crash, because that clearly drives variable sales. I think the last question I have here is, Randy, back to you. You mentioned a toolkit. Can or do we have access to the toolkit that Randy is describing?
Well, if you want to have a proposal run on what that stretch IRA versus non-stretching and putting life insurance, reach out to me and I can help you. Gonzalo, we should probably talk about whether or not we can create a agency one version of that. I'll leave that offline, but I might be able to help you come up with
I think that'd be very powerful. That was a new idea to me this week, and I think it's a really fun idea.
It's an idea that I created at a carrier, but it's my idea. I can recreate it. So
great. Well, for I think Ralph, you asked that question. Just call me offline. We'll talk about it. I do have a couple other quick questions that came in pre-webinar. So and then we're kind of butting up against the time, so we'll wrap up with this. We already covered that. There was a question on generational split dollar, and we talked a little bit about it before the session. We're waiting on guidance from the IRS regarding the Morissette case, and so those two questions kind of came in together. Just thoughts on split dollar very quickly, and generational split dollar very quickly. I know a lot of people are still writing it out there.
Right. We need to be clear what we're talking about. Way before anybody called it generational split dollar, I had grandparents providing the premiums for policies on either children's lives or grandchildren's lives, typically in irrevocable trusts. So I guess I was doing generational split dollar 3 decades ago. So if that's what you're talking about, there's absolutely no question. It worked 30 years ago, it worked 25 years ago, it works today. The question is, when the person who put up the premiums died, how do you report that for federal state tax purposes? So if you are presenting to your clients that this is an awesome thing, even if it's 100 cents on the dollar at death, then you are doing your job. Because the one thing we can't say until the tax court gives us a final ruling in Morissette is we cannot say to a client, you're going to get some colossal discount, because we don't know that that's true. And there's some logic to why you shouldn't get a colossal discount. But the power of split dollar and the power of life insurance is so enormous that you ought to be doing this without promising the back end discount. Randy?
Alan, that's a great answer. The only thing I would add is the final split dollar regulations, which control how split dollar works, makes no reference to any generational. It's an arrangement between two individuals. There's zero reason you can't do split dollar between a parent and a grandparent or whatever generation. As Alan said, though, the question will come down to is what is that valuation going to look like, whether you die with the note in your state or whether you transfer it during life. There's a lot of very aggressive things that are being done in that area, and that's where we got to wait to find out more. But
Got it.
But it's great. But on its face,
It's great planning. People should be doing it.
Accepting a no discount, I'm certain it works.
Yep, got it. Thank you for that. And I know there's still some, you know, we're waiting on more set, I guess. And there was one other case that we were kind of waiting on. What was the name of that case? And I don't know if that's been resolved in the court cases.
We have
Randy,
no, you know, I actually get I'm on a Bloomberg tax law tickler that they have promised me that the first case that comes down, it will be emailed to my box. I'm telling you, it hasn't happened yet. We don't have have those cases.
Got it. Okay. I think that's all the questions I've got. Gentlemen, I can't thank you enough for your time and your insights today. And Kathy, back to you.
Thank you, Gonzalo. And thank you, Randy and Alan. That was terrific. For those of you that would like to listen to this webinar again, it will be available on the Agency One YouTube channel. And I realize that we did not provide contact information for either Alan or Randy. If you would like to follow up with either of them, please reach out to Lisa or to Gonzalo or myself, and we will be happy to connect you with either or both of them. Now, for what is next. I know that I mentioned earlier that we are going to be hosting these webinars every other week, but rules are meant to be broken, and we are going to break this rule right out of the gate. You've heard a lot of discussion in this past webinar on Section 7702, and we thought that that topic was so important that we were going to make that the focus of our next webinar. So we're going to host a webinar next week, Thursday, January 28th at 4 o'clock Eastern Time with Bobby Samuelson. Please mark your calendars. Bobby is going to be discussing the recent changes to Internal Revenue Code Section 7702 and how these changes will directly impact life insurance products and case design on a moving forward basis. You should be receiving an invitation to this webinar sometime this afternoon. And then the following Thursday, February 4th at 4 o'clock, we're also going to be hosting a webinar featuring Samantha Russell, who is the Chief Marketing Officer for 20over10, which is an advisor marketing firm that has revolutionized the financial tech industry over the last decade. Samantha is going to talk about how to engage with your current and prospective clients through hyper-personalized digital marketing. Those are my closing announcements for today. If you have any questions or would like additional information, please reach out to Gonzalo or Ed or Dennis or myself. Thank you for joining us. And again, we hope you will join us next Thursday afternoon. That concludes this session. Thank you, gentlemen.
Thank you, everybody.
Thank you.
Bye-bye.
Take care. Thanks.